This is Nightly Business Report with Bill Griffith and Sue Herrera.
Stocks rocked. The U.S.-China trade war intensifies, sending shockwaves through Wall Street and rattling the global economy.
Ready to act, the Federal Reserve says it will do what is necessary to support the economic expansion, but adds that there is no rule book for a trade war.
Protect your portfolio. What you can do to keep your money safe and your personal finances sound in a market like this. Those stories and more tonight on Nightly Business Report for Friday, August 23rd.
And we do bid you a good evening, everybody, and welcome. Investors went into this day knowing it was going to be an important one for the markets, and it was, but not for the reasons that they thought. It wasn't the highly anticipated speech from Fed Chairman Jerome Powell that sparked today's intense selling. Instead, it was a new round of tariffs imposed by the Chinese government on U.S. goods. And then, by President Trump's response to them late today, he's hiking rates on even more Chinese goods. And his Twitter feed was active all day as well, all of which served to escalate the trade war between the world's two largest economies. That clouds the outlook for the economy, and it rattled Wall Street once again. Here are the closing numbers for this Friday. The Dow Industrials down 623 points to 25,628. NASDAQ fell by 239, and the S&P fell 75. Seema Modi walks us through this day from the New York Stock Exchange.
It was another dizzying day for the stock market. Equity futures initially rose on a series of encouraging comments from Fed officials. But just before 8 a.m. Eastern, China announced retaliatory tariffs, firing its latest salvo in the U.S.-China trade wars. That immediately sparked a sell-off. At 10 a.m. Eastern, stocks briefly lifted off their lows when Fed Chair Jay Powell restated that the Fed would be ready to act as needed to sustain the economy. But an hour later, President Trump launched a series of tweets taking aim at Powell and China, escalating the trade war. That sent the market spiraling, and the sell-off was broad. Trade-sensitive names like Apple, Caterpillar, and 3M all fell. Semiconductor stocks were lower. FedEx and UPS lost ground, pressuring the entire transportation sector. And the Dow broke below a key technical level. Not the way many long-term investors wanted to start the weekend. For Nightly Business Report, I'm Seema Modi at the New York Stock Exchange.
So the trade war took an ugly turn. As Seema mentioned, it started with China saying it would impose retaliatory tariffs on additional U.S. products and ended with the president firing back. Ilan Mui has the details from Washington.
President Trump doubled down on the trade war with China in response to retaliation from Beijing. He announced that on October 1st, the current 25% tariffs on $250 billion of Chinese goods will go up to 30%. And on September 1st, the Chinese imports that were supposed to be taxed at 10% will now be hit with a 15% tariff. Earlier today, Trump tweeted that the U.S. is better off without China and ordered American companies to immediately start looking for an alternative. But it's unclear how the president could enforce that order. Firms like Apple, Dell, and Nike are already considering moving their supply chains, and experts say multinational companies will continue to do business there.
China's a huge market. You have to be in China to serve that market. To tell American companies to go out of China would be, hugely crippling to the U.S. economy relative to the rest of the world, which is becoming more integrated with China.
China is slapping tariffs on $75 billion of U.S. exports like aircraft and oil. The tariffs range from 5 to 10%. Some take effect September 1st, others December 15th. Existing tariffs are already weighing on the U.S. economy.
The reason why the economy is struggling is this trade war, and the trade war is not working. It's doing significant damage to our economy. It risks running the economy into a ditch. And at the end of the day, I just don't see this getting where we want to go.
Automakers are also getting hit by 25% tariffs. They already got slammed last year in a previous round of tariffs. U.S. exports of finished vehicles dropped by 50%. All the whiplash is taking a toll.
It's not just the tariffs that are in place, but it's the tremendous uncertainty about where this policy is headed and will there be closure anytime soon. And that's weighing on business confidence, and we're seeing it on investment.
Business groups say they just want both countries to get back to the negotiating table. For Nightly Business Report, I'm Ilan Mui in Washington.
Now, those retaliatory tariffs announced first thing this morning by Beijing are set to go into effect September 1st. That's the same day that one set of President Trump's tariffs on Chinese goods also go into effect. In the meantime, as Yolande mentioned, the president immediately ordered U.S. companies to look for other opportunities around the world for production. But as Eunice Yoon reports, that's easier said than done. She is in Dongguan, China, for us tonight.
With new tariffs just days away, American businessman Alfred Lespina is in China looking for suppliers anyway.
The truth is, Eunice, right now is there isn't another alternative for us.
Lespina helps run eLumigen, a Michigan-based startup that specializes in industrial lighting. The company was hit with 25% tariffs in May and expects more products to be struck on September 1st. That pushed Lespina to explore other countries to source his goods, but none could match China.
For Lespina, factories like this are the only ones that can make what he needs at an acceptable cost. Workers have years of experience, and oftentimes the entire supply chain of a product is here.
Those advantages have helped this supplier shrug off the U.S. tariffs. Singapore-owned Aztec has been manufacturing in China for 25 years.
Any additional cost is actually bear by the customers, right? So that doesn't impact us a lot.
So then you don't split the costs.
We don't.
Have your orders from the U.S. gone down because of the tariffs?
No. In fact, we see an order increase.
But that means Lespina and his startup have to contend with the extra cost and uncertainty of the trade war.
The tariffs are concerning not only for the impact in the cost and pricing today, but also in our planning going forward. Is there another tariff? Will there be more levels? How does that impact our positioning in the marketplace? That is critical to us.
For Nightly Business Report, I'm Eunice Yoon in Dongguan, China.
And all of that trade talk overshadowed Fed Chair Jerome Powell's speech on monetary policy. And trade is just one of the mounting challenges facing central bank policymakers. Steve Leisman is at the Fed's annual symposium in Jackson Hole, Wyoming.
Federal Reserve Chairman Jay Powell at his keynote speech at the Fed's annual summit here in Jackson Hole guardedly suggesting that the Federal Reserve could be cutting interest rates in the months ahead. Even though Powell said the U.S. economic outlook is favorable, he noted there's evidence of global growth deteriorating further, that trade policy is playing a role in that global slowdown, and that business investment and manufacturing have weakened both. He said there's only so much the Federal Reserve can do to address trade policy, but he did say the Federal Reserve could address some of it or some of the fallout from it. Powell's top deputy, Richard Clarida, in a CNBC exclusive interview, backed up the chairman's outlook.
You know, the economic outlook is favorable. The economy's in a good place, but there are some significant risks. The global economy is slowing. There are powerful disinflationary pressures. There are uncertainties about trade policy, and those are factoring in. You know, we run monetary policy for the U.S., but we have to take into account global developments. They impact exports, they impact inflation, and we're going to factor that in as we need to.
Other Fed members here in Jackson Hole supported the idea of lowering interest rates, but for different reasons.
What the market thinks inflation is going to be over the next 5 years, let's say, and you adjust it because it's CPI, you adjust it to PCE. Market's only expecting about 1% or 1.1% inflation. So we're supposed to hit our inflation target. That's one reason why I've argued that, you know, we should get lower here.
But it became apparent here in Jackson Hole that the Fed chairman faces a divided committee. Not every Fed official thinks it's appropriate to lower rates.
My sense was we've added accommodation, and it wasn't required in my view. So I'm observing the downside risk, and right now I'm really focused on what the Federal Reserve has to do to achieve its mandates. And in my view, with this very low unemployment rate, with wages rising, with the inflation rate staying close to the Fed's target, I think we're in a good place relative to the mandates that we're asked to achieve.
The Fed meets in September with markets expecting a rate cut and indeed 3 rate cuts by the end of the year. Fed officials say they'll be keenly watching global economic developments, potential further escalation of the trade war with China, and how all of that affects the U.S. economy, figuring out the right place to set interest rates. For Nightly Business Report, I'm Steve Leisman in Jackson Hole, Wyoming.
Alicia Levine joins us now to talk more about all of this, the Fed, the escalating trade tensions with China, and the impact it's having on our markets. She's chief strategist at BNY Mellon Investment Management. Good to see you again. Thanks for joining us tonight.
Nice to see you on this busy day.
A lot to digest, that is for sure. So on the one hand, you have 2 new rounds of tariffs. On the other hand, you have a Fed chair who hinted that he's ready to cut rates if necessary. Net, good or bad for the stock market today overall?
So overall, the stock market really reacted more to the escalation of the trade fight with China.
Right.
And the fact that not only is China putting tariffs on, but that the U.S. is escalating. The thing I'd say about that is that the Chinese action is really interesting because it is exactly mirroring what the U.S. is doing September 1st and December 15th. And to me, that suggests a negotiating strategy. So the fear that was in the market today should not be unexpected, but investors shouldn't be running out of the market either.
So late today, we did get a ratcheting up of those tariffs by the administration. How do you anticipate China reacting to that Monday morning or late Sunday night?
So things could definitely get worse before they get better. So you could see restrictions on U.S. companies in China. You could see restrictions on joint ventures in China, because ultimately China is running out of goods to tariff because they only import $75 billion from the U.S. So there are other mechanisms where they could make life difficult for U.S. companies. We should expect something. And of course, there's the currency issue. A couple of weeks ago, we had weakening of the Chinese currency, which did send shudders through global markets.
Now, ordinarily, hearing a Fed chair hint that rate cuts are coming would have sent the stock market higher. But as you pointed out, it was the trade tariff tiff that got Wall Street's attention today. But all things being equal, the tariff war could mean lower rates from the Fed down the road. Does that help the stock market or not at this point?
So I think what we heard from Chair Powell today is that the Fed is ready to go 25 basis points in September. And I believe he left the door open for an additional 25 basis points by the end of the year. Absent the trade war, I don't think we would have heard that today. So clearly the deterioration in the global outlook is causing the Fed to become more dovish and to be more open in cutting rates. Ultimately, that will affect stock prices to the positive side and will support stock prices.
Where do you come down on the issue of recession here in the United States? Are we closer than you thought perhaps before or not? There are very divided opinions on that.
That's right. It's actually a great question because the data are really unclear. On the one hand, the consumer data and the labor market continue to be strong. And as we know, the consumer is 70% of the U.S. economy. So as long as Americans keep on shopping, we're fine. On the other hand, some of the forward-looking data, the sentiment data, the intentions for capital expenditures are weakening, and they're starting to look like they're rolling over.
Right.
That does mean that there's a place for the Fed to cut and to help stabilize the economy. And then the other question is whether the manufacturing recession worldwide comes and hits the U.S. economy.
Indeed.
That is an open question.
Alicia Levine with BNY Mellon Investment Management. Again, thanks for joining us. Have a good weekend.
Thank you.
Well, needless to say, it is an interesting time for leaders of the world's major economic powers to meet, and they are this weekend. Eamon Javers reports on the long list of issues they'll be tackling.
President Trump departs tonight for the G7. France will play host to world leaders in the seaside town of Biarritz. This year's official agenda includes promoting gender equality, climate, and strengthening globalization through trade. But the ramifications of the U.S.-China trade war will likely dominate the conversation, particularly on the heels of the latest tit-for-tat, though China is not a member of the G7 and Xi Jinping will not be present. Of course, the EU is not immune to Trump's focus on trade either.
We have all the cars in this country because all we'd have to do is tax their cars and they would give us anything they wanted.
He's repeatedly suggested he'd like to slap tariffs on European cars, as he did earlier this week. And French wine has also been a target. Currency manipulation is among the administration's list of concerns, as well as the French digital tax, which would hit the biggest U.S. tech companies. Trump has bilateral meetings scheduled with French President Emmanuel Macron, Germany's Angela Merkel, Canada's Justin Trudeau, Japan's Shinzo Abe, and India's Prime Minister Narendra Modi, as well as the UK's newest Prime Minister, Boris Johnson. That meeting will be closely watched as the two hope to wrap a trade deal which could be announced before the UK officially exits the EU in October. The expectation bar is set pretty low for this one. Organizers are already saying there may not be a traditional end-of-summit communique as has been done in the past. Last year, they couldn't agree on one and get the president to sign it. This year, the administration tells me they're happy not having any communique at all. For Nightly Business Report, I'm Eamon Javers at the White House.
Still ahead, where our market monitor is finding value in this volatile market. New home sales dropped sharply last month from June, but if you compare sales to last year at this time, they're actually higher. And that could be because the drop in mortgage rates is starting to have an impact. Diana Olick has more.
Home builders are suddenly seeing more demand this summer after a slow spring. Sales of newly built homes bounced 4% higher annually in July, according to the U.S. Census, which measures signed contracts during the month, so a very recent read on demand. June's reading was also revised sharply higher. Prices for new homes were also slightly lower than last year, helping affordability, but falling mortgage rates were likely a stronger driver. Mortgage rates began falling in May, but did pop up slightly in July when these sales contracts were signed, but rates were still far lower than they were in July of last year. Sales of existing homes gained in July as well, coming in higher than July of last year, the first annual increase in more than a year. That read measures closings, so people out shopping in May and June when rates were falling more sharply.
While lower rates certainly boosted summer sales, there is concern that the reasons behind those lower rates, that is a potentially weakening economy, could hurt consumer confidence and cause buyers to pull back once again come fall. For Nightly Business Report, I'm Diana Olick in Washington.
Foot Locker slips and falls, and that's where we begin tonight's market focus with the athletic footwear and apparel retailer reporting earnings and sales that missed analyst estimates. The CEO said demand was weak for its apparel, and he said the company's trying to figure out how to soften the blow of tariffs as well. Shares dropped nearly 19% today to $34 even. An increase in online sales helped accessories retailer Buckle surpass analyst estimates. The clothing company has now topped revenue expectations for 3 out of the last 4 quarters, but that didn't help the stock price today. It dropped more than 3% to $18.02. Red Robin Gourmet said that fewer consumers dined in their restaurants last quarter, but that was offset by greater demand for its delivery services. The chain reported better than expected earnings and revenue as a result and reiterated its full-year outlook, and shares rose nearly 6% today to $34.90.
It is time now for our weekly market monitor, who has some names that have value. And he says they'll help you navigate the stock market volatility. The last time he was on in July 2018, he liked Novacure, which is up 149%, American Tower, which is up 60%, and Yelp, which is 20% lower. Joining us tonight is Richard Steinberg, Chief Market Strategist at the Colony Group. Richard, great to see you.
Good to see you, Sue.
All right, what a day to have you on. A lot of volatility, and that's probably not going away. Your first pick is...
we should expect more.
I think so. Lowe's is your first pick. Why do you like it?
This is owned in our growth portfolio. It's one of our largest names. It's the second largest home improvement company behind Home Depot, which is still the class act of the group. But Marv Ellison came on from Home Depot as the new CEO. At first, when he came on, there were high hopes. The stock sold off, but we think this second quarter earnings is really a catalyst. We have a $140 target for it, and I think it's a name for a long-term growth portfolio.
I'm betting that this next company is also in your growth portfolio. It's called Nice, and I was looking at a chart today. In the last 5 years, it's essentially tripled in value here. You still like it, though?
This is an Israeli-based technology company. It's in our Analyst Select portfolio and in our growth portfolio. I actually own this one personally also. The company does call center software as well as financial crime and compliance software. They recently made an acquisition called In Contact, which is in the cloud space, within the call center space. The CEO is a visionary. This is a classic case of amazing Israeli technology. We think if you are willing to hold this for a long period of time, it's a great long-term name, and we have a $189 target on it.
All right, and you're sticking with one of your previous picks, and that is Novacure.
We're doubling down.
You're doubling down.
We're doubling down.
Why?
This is in our special situations value portfolio. The company is a really cutting-edge technology, health technology company in the cancer space. Think of Odyssey 2000 with an electrode kind of device. It has had great results in both glioblastoma and mesothelioma. I always have trouble with those. And they're showing some great clinical efficacy in non-small cell cancer. And I think this is a name that could continue to be owned.
Okay.
We have a $122 target. And if the cancer clinicals go well, it could be higher than that.
Rich Steinberg with the Colony Group. Rich, thanks so much.
Take care. Good to see you.
Tonight, by the way, the business world is mourning the loss of David Koch. Of course, he was best known for his political activism, but he also ran one of the nation's largest privately held conglomerates, Koch Industries. Its investments included subsidiaries in manufacturing, chemicals, fibers, and minerals. Mr. Koch and his brother Charles financed one of the most influential conservative political networks in the modern era. David Koch was 79 years old. It's a question being asked a lot lately. Is a recession coming? A lot of rumblings among economists and market watchers and investors and consumers. Some financial experts say that a decline in economic activity and a widespread drop in spending is inevitable. There are those who disagree. But what does it mean for you? Our senior personal finance correspondent, Sharon Epperson, has some suggestions on how to recession-proof your life. Welcome
Excellent.
aboard.
Thank you.
Here's that question again. So what do you do first? What do you say?
The first thing is not to panic, to breathe, and focus on what you can control. And the first step there is to look at what you have coming in. What money do you have coming in? What is your income? And there, focus on your job and protecting your job and the stability of your job. To do that, step up your performance right away. Go in Monday morning deciding you are going to be a critical player to whatever the bottom line is for your company. Make sure you update your resume, your LinkedIn. Those should always be updated. And you should always be networking, talking to your professional contacts, and making sure that you know what's going on in the industry, in your company, and outside of your company.
Just in case, because you never know.
Just in case, you never know.
And shoring up your finances, right?
Right. You never know. And if you do become unemployed, you want to have that rainy day fund. So the first thing you need to do is make sure, as a lot of people say, you should have 3 to 6 months worth of your living expenses saved. But if you're unemployed, if we go by what happened after the Great Recession in 2011, it took them 29 weeks to find a new job. So you may need more money than you think. So maybe 6 months to 12 months in that cash reserve would be best. Put it in a high yield bank savings account. And then also some say consider getting a home equity line of credit. Not that you're going to use it, but that you have it just in case you need funds to tap.
You know, it's early. I mean, people are going to be sitting there saying, what are they talking about? The economy looks good right now. And it occurs to me, a lot of what you're saying is what we should be doing anyway.
You should be doing it all the time, not using all your credit cards all the time, maybe using debit card instead of credit card, paying down that debt. All of those things are very important, and thinking about where you're putting your investments, not just what you're investing in. Make sure you have that tax diversification. You know I love Roth accounts, so make sure you have some money in that too.
Sharon Epperson, always good advice. Thank you.
My pleasure.
Have a good weekend.
You too.
Well, before we go, here's a look at the final numbers from this wild day on Wall Street. The Dow dropped 623 points. The Nasdaq was down 239. The S&P 500 fell 75. The major averages were all lower for the week. And that is Nightly Business Report for tonight. I'm Sue Herrera. Thanks for watching. We'd like to remind you this is the time of year your public television station seeks your support.
I'm Bill Griffith. We do thank you very much for that support. Have a great weekend. See you Monday.